now.
Hey, hello Suleiman. It's very nice to meet you. We wish if Ruth could join us today, but yes, she is a very busy woman. Let me introduce you to my colleague Sahil, who's an expertise in insurance and asset management, and Jimin, our portfolio advisor, and myself, Nikhil. We'll help you to guide you through the financial situation that your family is currently facing. So let's start. How can we assist you today in creating a financial plan and the path to achieve your future goals?
Hey everyone, I'm very glad to get to talk to all of you and get your expertise and advice on my family's finances right now. We've been really busy with our lives and careers, and we haven't had the time to really sit down and plan out our finances. We're currently going through lots of big changes in our careers and lives, and we aren't sure what the best plan is for now and moving forward in terms of our financial plan.
So don't stress over it too much. It's never too late to get your financial matters in place. In fact, with all the changes that your family is going through, creating a plan right now is the perfect opportunity to ease your stress and assure your family is financially comfortable in the future. So would you mind telling us what are your concerns?
So my first concern is that my kids are doing really good in high school right now, and I'm planning for them to go to university or college. I would like to start saving up money for them to help pay for the education costs, but I'm not sure what the best option is for saving. And I'm afraid that I should have started saving earlier.
So the best option would be opening up a RESP, which will be the most effective way to save for your kids' education. While it is more beneficial to start a RESP for your children when they are younger, it's still possible to reap the benefits of the RESP before the cutoff date at the end of the calendar year before the child turns 17. May I ask you how old are your kids?
My oldest is 15 and my youngest is 14.
Oh, so there's still some time for you, Andrew, to take advantage of the RESP benefits. The government will give you a grant called the Canada Education Saving Grant. It is meant to the top of your contribution to the plan of 20 by 20%, up to a maximum of $500 per year, which means if you can contribute 2,500 per year, you can maximize the grant you will receive up till $7,500. Since you are starting late to open the RESP and contributing, the government lets you carry forward your CESG room to the current year. This means that you will be able to receive a maximum of $1,000 of CESG per year if you contribute 5,000 per year as well. You will be able to get this $1,000 grant until your kids turn 17, which means there is time for you to take the advantage of these grants.
It sounds excellent. Where would I be able to open up a RESP for my children?
That's a good question. You can open up an RESP at many different institutions around your area. It could be at a bank, a credit union, a mutual fund company, or even an investment dealer. How else can we assist you in your financial situation?
Since me and my wife are accumulating more and more assets throughout our lives and with our career growth, we want our assets to be eventually transferred to our kids so that they can benefit from it when we are gone. I heard that establishing a trust is an effective method for this, but I am a bit hesitant to go through this route because I heard trusts are for rich people with complex financial and investment affairs only. So I was wondering who should establish a trust and who shouldn't.
That's a very good question, Salman. A lot of people think that trusts are only for reserved for wealthy people with high value investment and assets who have complex financial situations, but that's not true. Trusts are a common way of dealing with a variety of personal, family, and business options. There are many trust options that can help you meet your financial, estate, and tax planning needs. How do you want your assets to be given to your children?
So we want to establish a trust that would accumulate income within the trust fund. Then we want to pay a payment of the entire fund to our children once they reach the age of 30.
In that particular case, we would suggest that you guys establish a conditional family trust, which is very useful for holding assets and investment for the benefit of your children. The payment of the entire fund would not occur until your children turns 30-year-old. This type of interest is also very tax effective because of its designed properly. The transfer of investment assets to your children will achieve significant tax savings because of any potential capital gain will be taxed in your children's hand at a lower tax rate. However, please keep in mind that a family trust is an intervival trust which is taxed at the top marginal income tax rate for the first 36 months.
I see. It's very useful. Thank you. Another concern of mine was if I needed life insurance, how much life insurance would I need?
How? So Solomon, accessing your situation, I would like to suggest you should be opting for term life insurance since it is easy to buy and very simple, very easy to afford as well, and it makes an ideal for young grown families like you. So the insurance, term life insurance you should be going forward for is the term 20 life insurance. It gives you a coverage for both your wife and you, and the coverage amount for the same is $1 million, and the premium would be just 750 a month. And this would be providing you backup in case of any unfortunate death, uh, giving you backup for your business and your financial life, as well as the coverages are guaranteed for your entire terms, and you can renew the policy at the end of term.
Okay. Um, in addition, I was wondering about buying rental property for passive income.
Okay. Rental property is a best, I would consider a best source for passive income, considering the other investment you could go forward for like stocks and other types of investment. Rental property gives you an edge over them because it provides you a passive income. You have the the property might appreciate its value in the near future, and it also provides you benefit of getting tax deductions as well. But before going forward to it, you must consider the factors before buying such a rental property. That is, are you considering yourself to be going to be regularly checking your property? Are you taking into consideration the expenses that might occur in the future, and the loss you might get forward? And also you should be looking upon the operating expenses of the property. So I would like to conclude by saying that you should also look forward the disadvantages associated with buying a rental property. That would be like if your property lays vacant for a long period of time, that would be a concern for your insurance. You might lose it. Then you might not find a perfect tenant every time, so you have to take into consideration if you find a bad tenant, you might have a loss on the property, and the property might not appreciate in the future. It could depreciate its value, which would lead to a loss for you.
Okay. Thank you so much for your explanation. I think I have a better idea of investments and going further through this um, with my own money into this. Another concern I had was about the mutual funds. Which mutual funds should I have in my retirement account?
That's a good question. The choice of mutual fund in your retirement account depends on your goal. I think in your case, in saving for retirement, a traditional 60-40 portfolio in low-cost mutual fund would be the best. To get the best diversification, the 6% equity portion should be include Canadian, US, and global equity index fund, and the fixed income portion would be mostly Canadian bond index funds. These are low-cost mutual funds and have inexpensive MERs, which is management expense ratio. Other options include a tilt toward more active strategies, but these are more expensive.
Okay. So in addition, I was wondering if there were any blind spots in my financial life that I should be aware of for me and my family.
Well, tax efficiency would be your biggest concern. You can use an RSP to reduce your annual income tax and shoulder the capital gains and interest until you withdraw the money from the LRSP. You are working and should check with your employer to see if they offers an employer pension, either a defined benefit or a defined contribution plan. Also will reduce your RSP contribution room, but may offer a good product. I can review this with you if you like. Most of you will receive OAS, but only you will be contributing to their CPP. And I would like to review your potential income from this so we have a complete picture.
Yeah, for sure. I would love to review my financial plan with you guys. And from talking to you guys today, I think I'm in a better position for my family to reach our financial goals.
Thank you, Solomon. So
Thank you
we
very
would
much.
be giving you a draft about the whole conversation that we had so that you can review with your wife, Ruth, and you can get back to us. You have our email address, so just get back to us if you have any concerns and we'll love to solve it for you.
Sounds good. Thank you guys.
Thank you.
Alrighty, have a good evening.
Thank you.
See
Bye
you
guys.
guys later.